Okay, so you want to own a hotel. Find a building, fill the rooms, charge guests a rate per night, and collect the difference between what it costs to run the place and what people pay to stay there. It sounds like one of the simplest businesses imaginable. The same square footage generates revenue every single night of the year, indefinitely. And like most dreams built around real estate, it survives contact with reality for about as long as it takes to read the first loan agreement. The actual economics of hotel ownership involve a set of structural problems that are genuinely unusual, even compared to other commercial real estate. The margins are thinner than they appear. The costs are more fixed than they should be. And the relationship between who owns the building and who runs it is one of the stranger arrangements in all of business. Let's start with what you are actually buying. A hotel is not a single asset. It is a building wrapped around an operating business, and those two things have very different risk profiles. The building depreciates, the business fluctuates. The land underneath might appreciate over decades, but the revenue generated by the rooms on top of that land can swing by 30% or 40% in a single year based on factors entirely outside any owner's control. A new competitor opens nearby. A convention relocates. Any of these can cut occupancy dramatically, and the fixed costs of the building do not move when occupancy drops. The mortgage payment stays the same whether the hotel is at 90% occupancy or 40%. Before discussing what a hotel earns, it is worth understanding what it costs to acquire one. Hotel valuations use a metric called price per key, which simply means the purchase price divided by the number of rooms. A limited service hotel in a secondary market might trade for $80,000 to $120,000 per key. A full-service hotel in a major urban market might trade for $300,000 to $500,000 per key. A luxury property in a top-tier city can exceed $1 million per key. In 2023, the Surf Club in Miami sold for approximately $1.1 million per key. The Waldorf Astoria in New York sold in 2014 for roughly $1.4 million per key, which at the time was the highest price ever paid for a hotel in the United States. The standard valuation framework for hotels uses a multiple of net operating income, similar to the EBITDA multiple used in airport transactions. Depending on the market, the property type, and the brand attached to it, hotels typically trade at income multiples between 12 and 18 times. A full-service hotel generating $8 million in annual net operating income might therefore be valued somewhere between $96 million and $144 million. That range gives you a sense of how much uncertainty sits inside a single transaction, because what a hotel earns in any given year is not a stable number. It moves constantly, and the direction it moves is often determined by forces the owner has no ability to control. The fundamental revenue metric in the hotel industry is called RevPAR, which stands for Revenue Per Available Room. RevPAR is calculated by multiplying a hotel's average daily rate, or ADR, by its occupancy percentage. If a hotel charges an average of $200 per night and achieves 75% occupancy, its RevPAR is $150. This number matters because it allows owners and operators to compare performance across properties of different sizes. Industry benchmarks suggest that full-service hotels in major U.S. markets achieved an average RevPAR of approximately $140 in 2023, recovering from a low of roughly $55 during the worst months of 2020. Here's where the hotel business diverges sharply from most real estate. The revenue is not locked in. A landlord with an office building signed to a 10-year lease knows exactly what rent is coming in for the next decade. A hotel owner knows what revenue came in yesterday. Tomorrow is a different calculation entirely. Rooms are repriced continuously, sometimes multiple times per day, based on demand signals, competitive rates, local events, and algorithmic yield management systems. This is both an opportunity and a structural vulnerability. When demand is high, rates rise quickly. When demand collapses, rates drop just as fast. And because the hotel cannot hold unsold inventory, an unoccupied room on a given night is revenue that is gone permanently. The costs that absorb that revenue fall into two broad categories. The first is departmental expenses, the direct costs of running each revenue-generating department in the hotel. Rooms department expenses include housekeeping labor, laundry, guest supplies, and reservation systems. The cost of cleaning and maintaining a hotel room runs between $25 and $60 per occupied room night, depending on the property's service level and labor market. A 300-room full-service hotel with 75% occupancy is cleaning roughly 225 rooms per day. every day of the year. At $40 per room, that is $9,000 per day in housekeeping cost alone, before a single executive is paid, before the electricity bill is mentioned, before the mortgage is discussed. The second cross category is undistributed expenses. These are shared across the entire operation and cannot be allocated to a specific revenue department. General and administrative costs, including the management team, accounting, and human resources. Sales and marketing, which at a branded property might run between 4% and 6% of total revenue. Utilities, which for a full-service hotel typically consume between 4% and 6% of revenue, but can spike significantly in older buildings with inefficient systems. Property maintenance and repairs, which tend to be underestimated during acquisition and underinvested during ownership until something fails. When all departmental and undistributed expenses are subtracted from gross revenue, what remains is gross operating profit, commonly referred to as GOP. A well-run full-service hotel might achieve a GOP margin of 30% to 35%. A limited service property with fewer staff-intensive departments can reach 40% or higher. What the investor presentations sometimes underemphasize is what happens after gross operating profit. Property taxes on a large hotel in a major market can run into the millions of dollars annually. Insurance premiums for a full-service property with a pool, a restaurant, a spa, and several hundred rooms can easily exceed $500,000 per year and have increased substantially across the industry since 2020. The Furniture, Fixtures, and Equipment Reserve, commonly called the FF&E Reserve, is a mandatory replacement fund typically set at 4% to 5% of total revenue. Hotel rooms deteriorate faster than office space. Carpets, mattresses, televisions, bathroom fixtures, and upholstered furniture all have replacement cycles measured in years, not decades. A 300-room hotel, generating $15 million in annual revenue, sets aside $600,000 to $750,000 per year just to fund future replacement of things that already exist and are already working. After property taxes, insurance, FF&E reserves, and the management fee, what is left is net operating income, the number against which the mortgage payment is measured. This brings up one of the most distinctive structural features of the hotel industry. Who actually runs the hotel? In most commercial real estate, the owner operates the asset. A landlord owns an apartment building and manages it. In hotels, the ownership structure is far more fragmented. There are 3 different ways a hotel can be operated, and each creates a different economic relationship between the person who owns the building and the person who runs the business inside it. The first is direct ownership and operation, where the same entity owns the real estate and manages all hotel operations. This is common among independent boutique hotels and some smaller regional chains. The owner controls everything, keeps all the profit, and absorbs all the risk. The second model separates ownership from operations through a management contract. The third separates the brand from both. The management contract model emerged as hotel companies decided that owning real estate was not their core competency. Marriott, Hilton, Hyatt, and most other major chains today primarily earn money by managing hotels they do not own. Under a typical hotel management agreement, an owner hires a management company to run the property in exchange for 2 fees. A base management fee, typically 2% to 3% of total gross revenue, and an incentive management fee, typically 10% to 15% of gross operating profit above a certain threshold. The base fee is paid regardless of profitability. If the hotel generates $20 million in gross revenue and loses money after debt service, the management company still collects $400,000 to $600,000. This is not incidental. It is the design structure of the arrangement. The management company's base fee is senior to the owner's return. The brand franchise model separates the question of brand affiliation from management entirely. An owner who does not want a management company running daily operations can instead sign a franchise agreement directly with a brand like Marriott or Hilton, giving the hotel the right to use that brand's name, reservation system, loyalty program, and operating standards in exchange for a franchise royalty fee. That fee typically runs between 4% and 6% of rooms revenue, charged on top of all other fees the brand extracts. There are also program fees for participation in the brand's reservation system, loyalty program assessments based on the share of revenue generated by loyalty members, and training fees. Adding these together, a franchise property often pays 8% to 12% of rooms revenue to the brand before a single operating expense is paid. Why would any owner accept this? Because the alternative is operating as a truly independent hotel without access to a global reservation system or loyalty program that accounts for a substantial share of all hotel bookings. A hotel that opts out of these programs accepts a structural disadvantage in distribution that is difficult to overcome through any other means. The brand fee is effectively the cost of accessing a built-in customer base. For a hotel in an undifferentiated suburban market, competing without that infrastructure is genuinely difficult. The staffing structure of a full-service hotel creates a cost base that is both large and relatively inflexible. A full-service property with 300 rooms typically employs between 200 and 400 people, when accounting for housekeeping, front desk, food and beverage, engineering, security, sales, and management. This headcount does not scale efficiently with occupancy. A hotel at 40% occupancy still needs a front desk staffed 24 hours a day. The engineering team still needs to maintain every mechanical system in the building. The sales team needs to be in place to bring occupancy back up. Labor typically represents 30% to 35% of total hotel revenue, making it the single largest operating expense category. The food and beverage operation inside a full-service hotel deserves particular attention because it is a persistent source of confusion between what it contributes to guest experience and what it contributes to the bottom line. A hotel restaurant, a lobby bar, and a banquet operation generate revenue. They also generate costs that make them among the least profitable departments in the building. Food and beverage profit margins at hotels typically run between 15% and 25% before overhead allocations, compared to rooms department margins that can reach 70% or higher. The same square footage converted to additional meeting space would generate event rental revenue with far lower direct costs. Yet most full-service hotels maintain their restaurants because they are a brand standard requirement, because guests expect them, and because the food and beverage operation supports room revenue by making the hotel more attractive to group business. Group business, meaning room blocks booked by corporations, conferences, and associations, is the economic backbone of most full-service hotels. A single convention can fill 200 rooms for 3 consecutive nights while also purchasing $50,000 in meeting space and $80,000 in catered food and beverage. The revenue density of a successfully booked group piece of business is substantially higher than the same number of transient rooms booked one at a time. This is why hotel sales departments exist and why they are expensive. A director of sales at a 300-room full-service property commands a salary between $80,000 and $130,000 per year, with additional commissions tied to production. Revenue management is itself a sophisticated discipline that has developed substantially over the past 20 years. Modern hotel revenue management uses historical booking patterns, competitive rate data, local event calendars, airline capacity information, and demand forecasting algorithms to set room rates dynamically across dozens of distribution channels simultaneously. The goal is to maximize RevPAR by filling the hotel at the highest achievable rate mix. When done well, the difference between an average revenue management program and an excellent one can be 10% or more in annual RevPAR, which on a hotel generating $12 million in rooms, revenue represents over $1 million in additional income. The distribution channels themselves impose costs that erode that revenue. Online travel agencies, meaning platforms like Expedia and Booking.com, charge commissions between 15% and 25% of the room rate for every booking they deliver. A guest who books a $200 room through Expedia might generate only $150 to $170 in net revenue for the hotel after commission. This is why hotels invest heavily in driving direct bookings through their own websites and loyalty programs. A direct booking carries no commission. Managing this channel mix is a constant operational priority. The debt structure on most hotel acquisitions amplifies everything described above in both directions. A typical hotel acquisition uses debt financing covering 55% to 70% of the purchase price. At a 65% loan-to-value on a $50 million hotel, the owner borrows $32.5 million. At a 6% interest rate on a 10-year term, the annual debt service is approximately $2.9 million, regardless of what the hotel earns. If net operating income drops from $4 to $2.5 million in a bad year, the hotel's debt coverage ratio falls below 1.0, meaning the property is generating insufficient income to cover its own mortgage. Lenders typically require a debt service coverage ratio of at least 1.25. A hotel that falls below that threshold may face loan covenant violations, forced capital calls, or in severe cases, lender-mandated sales. The pandemic period illustrates what happens when hotel revenue collapses against a fixed cost base with no mechanism for relief. In March 2020, U.S. hotel occupancy fell to approximately 21%. Revenue managers had no useful historical data to reference. Hotels that had been generating comfortable returns 1 month earlier were suddenly consuming cash at alarming rates. The fixed costs, mortgage payments, insurance, minimum staffing, utilities, property taxes continued. By the end of 2020, the American Hotel and Lodging Association estimated that the U.S. hotel industry had lost approximately $111 billion in room revenue compared to 2019. The recovery from that period was uneven in a way that revealed deep differences between hotel segments. Leisure-focused hotels and drive-to-destinations, beach resorts, mountain retreats, and national park gateway markets recovered first and fastest, in many cases achieving record RevPAR by mid-2021. Urban business hotels, convention hotels, and airport properties recovered far more slowly because their demand base depended on corporate travel and large events that resumed gradually and incompletely. This divergence in recovery speed reflected the underlying demand structure of each segment, and it illustrated why a hotel's location and customer mix are more important determinants of long-term performance than almost any operational variable. The extended stay hotel segment represents a variation on the standard model that insulates owners from some of this volatility. Extended stay hotels, which are designed for guests staying 5 or more nights, benefit from longer average lengths of stay that reduce the daily revenue management challenge and significantly lower housekeeping costs. A guest staying 14 nights typically receives housekeeping service 2 or 3 times rather than 14 times. Labor cost per occupied room night drops substantially. Extended stay demand also tends to be less event-driven and more connected to steady baseline economic activity, construction projects, corporate relocations, government contracts, and healthcare assignments. The select service and limited service segments, which include brands like Courtyard by Marriott, Hampton Inn, Holiday Inn Express, and similar mid-scale products, represent the largest portion of new hotel construction in the United States over the past 2 decades. The operating model for these properties strips away the cost-intensive departments of a full-service hotel. No full-service restaurant, no room service, a breakfast buffet rather than a staffed dining room. The result is a labor structure roughly 40% to 50% lighter than a comparable full-service hotel, and a GOP margin that can reach 45% to 55% in strong markets. These properties dominate suburban markets, secondary cities, and highway corridors precisely because their cost structure allows profitable operation at occupancy levels where a full-service hotel would struggle. The development economics of new hotel construction have become increasingly difficult over the past several years. Construction costs for a new limited-service hotel in the United States, which ran approximately $90,000 to $120,000 per key in 2015, had risen to $150,000 to $220,000 per key by 2023 in many markets, driven by labor shortages, material inflation, and rising land costs. The revenue projections that made initial projects pencil out do not automatically scale to justify increased development costs. This construction cost inflation has significantly slowed new hotel supply in many markets, which, paradoxically, benefits owners of existing hotels by reducing future competition. The transaction market for hotels operates on a different cycle than most commercial real estate. Hotels are among the first assets to feel an economic slowdown because room revenue reflects economic conditions in real time, and among the first to recover because they reprice nightly rather than waiting for lease expirations. Distressed hotel acquisitions following the 2001 recession, the 2008 financial crisis, and the 2020 pandemic all produced substantial returns for buyers with access to capital at the right moment. Private equity firms have been significant buyers of hotel real estate over the past 30 years, typically acquiring portfolios of hotels with the intention of improving operations, cutting costs, refinancing at more favorable terms, and selling within a 3 to 7 year hold period. Blackstone Group, which has been one of the most active buyers and sellers of hotel assets globally, acquired the Hilton Hotels Corporation in 2007 for approximately $26 billion. Blackstone eventually exited the investment through a restructured Hilton IPO in 2013 and subsequent share sales, ultimately realizing a profit reported at approximately $14 billion. The transaction illustrated that even challenging hotel acquisitions can generate significant returns when the hold period is extended and the asset itself is fundamentally sound. The role of hotel real estate investment trusts, known as hotel REITs, has shaped the ownership landscape significantly. A hotel REIT raises capital from public investors, acquires hotel real estate, and retains third-party management companies to operate the properties under brand franchise agreements. Major hotel REITs, including Host Hotels and Resorts, Park Hotels and Resorts, and Pebblebrook Hotel Trust, collectively own hundreds of hotel properties with aggregate values in the tens of billions of dollars. For individual investors seeking exposure to hotel economics without buying a specific property, a hotel REIT share traded on a public exchange provides a liquid alternative. The economics of owning a hotel at the individual property level ultimately reduce to a relatively straightforward tension. The asset generates revenue that fluctuates significantly based on external conditions. The cost base absorbs that revenue through a combination of fixed and variable expenses that do not shrink proportionally when revenue falls. The gap between gross revenue and what eventually reaches the owner after operating costs, management fees, brand fees, reserves, taxes, insurance, and debt service is narrower than most outside observers expect. A hotel generating $20 million in total revenue might return $1.5 to $3 million to its equity owner in a good year. In a bad year, it might consume capital rather than produce it. The owners who have generated consistent returns over long periods are generally those who bought at the right point in the cycle, held through the downturns without being forced to sell, and owned in markets where demand was structurally growing.